Okay, welcome everyone, and I'm really happy that we are keep running these Friday events with investors, founders, and other experts. I am Alessandro Marianantoni, founder director at M Accelerator, an hybrid accelerator incubator program in downtown Los Angeles, and we work with students, founders, and early stage startups. Some of you may know that most of our participants are internationals. And a few weeks ago, during our winter session, we entered, as you may know, into a lockdown. And most of our participants needed to fly back home. So we started doing more of these online events. And definitely we needed also to move our programs, our winter cohort online so that we could keep supporting our participants and startups. And well, I say welcome to our guest today, guest and friend, Noble Drakoln. Noble is a managing partner at Noble Drakoln Capital Partners. Hi, Noble.
Hey, how's it going, Alessandro? Good to see
you. Noble, it's always a pleasure to have these opportunities to meet you, talk to you, and thanks again for accepting this invitation today. Had a chance, I definitely have the chance, right, of knowing your work, your past work, and I know that you've been working on very different shoes, right? Wearing different hats as a fund edge manager, investor, founder. I think also we can say rider and probably, I don't know, the whole variety, but
hey, listen,
please,
father
can
of
you
five.
tell?
Father of five and husband. That's
Father of five in a lockdown also. That would be interesting.
Yeah, so
Why don't you start telling a little bit about yourself, introducing to everyone what you do?
Yeah, so my background, I started off in the commodities industry as a broker. I did that for 25 years between broker and hedge fund. And during that time, I've written several books on trading options and trading futures and Forex. I've been a keynote speaker around the world. I've been a contributor on Fox Business News and Bloomberg. And I've done along the way a lot of different entrepreneurial ventures. I was in the space when the paging systems converted over into digital phones that we use now. So 150 megahertz and 450 megahertz bandwidth was converted into CDMA from TDMA, as well as I've been involved in various tech startups, either consultant or in my own. You and I met when right after I filed a patent on an augmented reality idea, taking clothes and making them come to life using mobile apps and AR and Unity. So I've been kind of worn multiple hats, but along the way, one of the things that I've always been consistent with is being able to have connections to people who are either accredited investors or family offices or an ecosystem in which investors are seeking deals. So that's kind of how Drakoln Capital Partners evolved. We were talking with one of my old relationships, and we realized that there was a need to get investors into quality deal flow at the pre-seed and seed level. Oftentimes, when investors hear about Uber or they hear about Lyft or they hear about any of these other awesome unicorns, it's so far down the road that they don't really have an opportunity to gain the maximum value for their investment or participation. They're oftentimes in round C or B, and nowadays people are going as far as round E. Whereas if you're able to get involved directly with an accelerator like yours, accelerator incubator, you're able to find really good quality founders and find ways to invest with them and kind of team up with them early on in that pre-seed and seed level, and they're still making their MVP. Who wouldn't want to be an investor in the initial MVP for Uber, right? So, or Airbnb. So that's kind of where we started falling to find that niche where we provide an opportunity to work with you, with all your great touch of founders and really motivated people. And our personal relationships with people with family offices were several hundred million to private investors who are just looking to kind of get their toe wet with, $25,000 and $50,000 investments, but really giving that much needed capital to private businesses and really strong founders. So that's kind of where we're at now.
That's great, and as you know, I'm always fascinating, and it's also my approach, the one that trying to work as in different projects, but also with different angles in a sort of a multidisciplinary way. And last week we hosted a very interesting panel of investors and founders, and we talked about startup pivoting. Always, of course, from different points of view between investors and founders. And we said that being a founder, it's somehow being always in a pandemic state, right?
Mm-hmm.
So it's actually, if anybody's listening and is interested in our past episode, I'm sure you can find it on our YouTube channel. But Noble, going back to this, to how startups should approach this crisis, these months right now. Did you see? What's your experience with your startups right now? I know you're working with some of them.
Yeah, we were working with several startups in several disciplines. We have a great company coming out of Australia that we're bringing in, and they have a special orthopedic sandal or flip-flop that they're bringing into the United States. They're called Aussie Soles. We've been really proud of what they've accomplished in Australia, but as the summer has ended there during the lockdown, the anticipation is that here, if there's any kind of opening leading into the summer, they'll have a real opportunity to really gain traction in the marketplace. So another company that is a laboratory. Originally, they were doing only genetics work for CBD and endocannabinoid systems. So we're helping them find capital now to acquire a lab that is COVID-19 focused, whereas the lab itself already does coronavirus testing and getting the proper arrays to do the COVID-19 testing. So that's just going to become a normal everyday part of life over the next several years. We have other companies that we're dealing with, tech companies in the AR space, companies in the licensing space, as well as we're talking to people who have businesses that are in mining. So gold, with anticipation that gold mining is going to be another big thing. So we're really finding that across a broad band of spectrums, we're having a lot of founders and startups reach out to us to get their message out, find investors, and get involved. And the way that we've done this whole process is fairly streamlined to get them in front of investors. So while maybe, and I was talking to someone the other day, I said, well, right now, a lot of private equity and family offices are kind of in a holding pattern to see what's going to happen. The private investors are a little bit more aggressive in wanting to diversify after you've seen how big the stock market fell. And really, those people who are private investors really comprehend that when you have 26 million people unemployed and economies across the United States kind of opening but not opening, there's going to be a long time before you kind of bring those people who are in the workforce, particularly those who were already kind of underemployed, back. And so those investors are looking for outlier returns, and they're really their eyes are open, and a lot more even now that most people are quarantined or self-quarantine of some sort. Even more so now, really looking at trying to participate in really good founders right now directly.
Yeah, so interesting. A couple of points there. Ourselves, I mean, last year, 2019, we received we received actually precisely 395 pitch applications from a variety of early stage, later stage teams and so forth. This year, during this period, we actually noticed a bump on the applications, and but definitely they were more like mature startups. Did you also notice this?
Yeah, a lot more mature startups. A lot of people, and that's why I say, our focus is really in founders in that pre-seed, seed, MVP, pre-Series A round kind of space, because they really find that those companies need more capital to either complete development, take care of payroll, or start finding a new niche to pivot to. And so, yeah, we're finding a lot of those companies. We're getting probably 3 to 4 people daily who are kind of reaching out, trying to understand exactly what we do, both on LinkedIn and several other services.
And according to your experience, I mean, can you see what are the main issues of these startups? What are the main issues as they are facing right now? I mean,
it's let's be frank, it's liquidity, right? Every business, no matter what it is, you can try and do one of two things. You can kind of bootstrap your way to growth, or you can accelerate your growth by taking on outside capital. And so a lot of these companies are finding that they just don't have enough capital just through bootstrapping, particularly now, where if they're not in a essential service or in which includes the food industry, mortgages, banking, some other core businesses, they really are having a hard time beginning to navigate where they're going to find the capital by just bootstrapping. And so a lot of these companies that are reaching out to us were really former bootstrappers, and they're trying to find a way to expand the mandate, because they know the rule that if you, as a corporation, can not only survive but thrive during a recessionary period, then you're set for a golden period thereafter. Look at Amazon. Amazon went through, .com one, when people were laughing that nobody would ever order toys online. That's why Toy Trade, eToys went out of business, and Pet, all this was all Web 1.0. All that stuff went out of business because no one believed that anyone would trust anyone ordering stuff online. Amazon survived that period, and Amazon is the number one toy seller in America, as well as pet supplies and other things. So it's the same instance that if you're a company that not only can survive but thrive through this period and really double down and making core investments in both your teams as well as your infrastructure, on the other side of this could be a huge boom for you, because you want to be one of the few last people standing.
interesting. There was also another point of your comment just earlier. You started talking about sort of, and you know that I grew up as coding, so I really like repeatable processes, narrowing down some of these processes. Eventually, you were talking about, I guess, fundraising. Did you see how is this process could be something that strategically we create a process in terms of interacting with investors? I mean,
yeah. So my whole career, yeah, you're absolutely right. So at DCP, what we did was we took a system that I've been doing since I first started in the brokerage industry, and it's a system that anybody can apply, whether they work with us or just kind of go all in on their own. And what we do is just very, very simple. We make sure that we're in compliance first and foremost. So we file what's known as the 506C, Reg D 506C, which allows an exemption for people to raise funds directly from accredited investors. And when those people either bring their 506C or refile the 506C, it allows them a lot of little caveats. It allows them to market and advertise their private placement. And for those people who aren't familiar with what a 506C is, it's the SEC, Securities Exchange Commission, allowing you to sell shares in your company direct to investors to participate as part owners in the business. And so there's a lot of nuances to that. You can kind of read the rules or reach out to us. But the bottom line is, one of the beautiful things of this Reg D 506C is that you can advertise and market it. And as long as you only receive accredited investors to participate in your business, you have never violated the exemption for selling shares or debt instrument, which is great, because in the United States alone, there's over 13 million accredited investors. So the system we have is we will help people get their 506C filed, and then we'll turn around and we have a team of dialers who will survey people who are accredited investors to make sure that this is a product they'd be interested in. And we hand that off to the owners to then talk to them about making an investment. And so by creating that flow of profiling with the call center, we've been successful in helping people raise funds. But one of the beauties of it is that while our team is making the calls, they make about 800 to 1,200 calls a day. That's not beyond the reach of anybody. When I started this business, I was making 200 to 300 calls a day to private investors to share my idea. And if you're willing, and that was when we were in the brokerage room, so we called them, share what was going on in the markets, bring them in. And so anyone can still implement that type of strategy. I believe that there's kind of an over-reliance on it, assuming that if you create Facebook ads or Google ads and you just advertise and passively wait, that you'll get the people who are the right people. And I think a combination of both direct contact as well as passive contact will get founders the funds they need. So there's, and that's kind of the system we have in-house to really reach out to accredited investors. There's a whole other system to kind of talk to angel investors. We talked about that on LinkedIn, how that's developed, as well as how to reach out to family offices. But for the most part, beginning or startup founders, it's just a lot more simpler to deal with accredited investors.
So, yeah, a lot of things, right? So let's break it down, and a few more questions so that we are. So in a way, you're saying that there are also there are several points I'm going to touch to about refer to what you said. I mean, you mentioned that there are several investors, and is it that during this specific times? I mean, is there a specific kind of investors you will go after, or there is actually an investors for all seasons?
Yeah, so I think the second one is more valid. There's an investor for all seasons, and one of the things that a lot of founders forget to do is to intersect both their minimum viable product, their MVP, with a level of systemization that needs to be brought to those people who are career angel investors as well as the VCs. And if you don't have a really solid MVP that's gained some traction, and you don't have some kind of systemization in place that can have where you can show a one-to-one correlation of new capital infused into the system creates X output, then you find it very difficult to raise capital. And there's so much uncertainty right now that a lot of the deals that are probably getting done in that ecosystem are more friend of friend or successful founders receiving capital as opposed to new founders. And so for those new founders, targeting and interacting with accredited investors is really the best way for them to get the seed capital. It's one step beyond just friends and family, but it's also fully registered with the SEC to allow them to reach out and talk to strangers to invest in the project. And so they can create that working capital needed to finish their MVP or set up the systemization necessary, and then they'd have to give up so much value, decrease their valuation so much when they're walking into raising funds from the next level of rounds. And trust me, the family offices and the career angel investors, they like to see guys who have brought in outside capital, who have applied the funds properly and know how to run the balance sheet and budget. So it's one of those things that it's to their benefit, and anyone can do it, but it's to anybody's benefit to know how to talk to accredited investors. For particularly when you file a 506C, there's an unlimited pool of investment that you can receive.
Yeah, great. So you're talking about regulation D 506C. I know that at least several times happened to me that founders they have no idea what we're talking about when we start talking about regulation D and regulation A and so forth. And I believe that just because maybe it's a very early stage startup, so founders are not that financially savvy. Like definitely I am, because I don't come from the finance world. But can we clarify a little bit? I mean, can we make some distinctions in Regulation D and Regulation A? Because there's a lot of Regulation A out there with this pre-IPO crowdfunding. So can we?
Yeah. Let's break it down a little bit. So if you're, let's say you're pre-seed, and if you have a deep well of friends and family, then 100% you shouldn't even, you can do a safe agreement, right? So it's, security agreement for future equity. And a safe, and that's Y Combinator has one, M Accelerator has a version, right, where you hand it to people and say, look, if we ever have a liquidation event, the amount you've given me or invested right now will turn into equity. And there's even crowdfunding sites that are doing almost like micro safe agreements, in which small investors who want to invest $100 or $50. So there's a broad spectrum of how funds can be raised, but there's also a limit to that as well. So you issued the safe agreement, you talked to a few accredited investors, but how do you then market and let other people who do not know you to invest? And that's where the Regulation D and the Regulation A offerings all come in. That there's an exemption under the Securities Exchange Commission which allows people to go to the public to raise funds. And they may need 5 million, 10 million, 20 million, whatever the amount is. And so with what people are most familiar with, they always talk about either the Reg A, which allows you to raise tens of millions, or 20, which is a pre-IPO version of your company. There's people who are familiar with Reg CF, which is regulation crowdfunding, which you can get on websites like Start Engine and WeFunder. And so there's these little measures that allow you to get out there. And I frankly, I think they're all great, to be honest. I think that if you have the ability to have a wide range of product, and you know how to do an aggressive online marketing campaign, you absolutely 100% can succeed in those type of crowdfunding, in which you're using a platform to now market and promote you. But what I've discovered is that a lot of those companies end up very quickly not raising the capital. That they have a lot of legal costs to set up, and we got calls just this past month over several people who are pre-IPO Reg A, and they're trying to do Tier 1, which is $20 million raise, and the platform they're on, they're not able to get anybody to invest in them. That doesn't mean their idea is bad, not necessarily. It just means sometimes that you're just not a great promoter, great marketer. And so when you get to the classifications, and we have a little PowerPoint on it, there's multiple ways. There's the 506B, there's the Reg G that falls under the CF, there's the Reg S, which allows only foreign investors to invest. So there's all these different ways. But for our company, we put one specific set in the regulations, and it's the Reg D 506C, which, just like Reg A, allows you to go to the public to raise funds. But in this instance, it can only be accredited investors who invest in you. But the beauty of it is you're allowed to market directly, and the founders are able to close the deals to bring in the funds directly into the business. And on top of that, you can raise an unlimited amount of capital necessary to grow the business. So to be sincere, you're not really capped on whether you're a Tier 1 to raise 20 million or 50 million. You can bring as much capital as you need in the business. Now, for all practical intents and purposes, going this route, we always tell people, if you did a Reg D 506C, you're looking at $1 million to $5 million, pretty decent seed investment. And that's how you build the MVP. That's how you focus on developing your systems. And then that's when you kind of go to the next phase. But hopefully that explains a little bit about that ecosystem and why the Reg D 506C is just a really good way for founders to directly market.
And yeah, that's really helpful. And you're talking, yeah, definitely you described the process and the several stages. But I wonder, and this is something also I've been asked to, is this process open, accessible, and it's a good fit for any kind of startups, or do you have, do you know that do you have any requirements to start it?
So the beauty of the regulation is it's open to any startup. That's not but the question is your story appealing enough? If you've not fleshed out your business plan and you don't have any kind of real pathway to growth and excellence, your idea of an MVP, or you even haven't developed an MVP at all, those things are going to work against you. Because just because they're smaller investors, they're credit investors, uh, individual credit investors, doesn't mean that they are not savvy, and doesn't mean that they'll write small checks. You know, you can have an individual or private accredited investor invest $250,000, $1 million in a business, and so they're going to take the same scrutiny as if they were just a regular part of an angel investing club. So I think that it's really on the founder to create the value proposition, and that's why we enjoy working with you, Alessandro. You take at M Accelerator, you take everybody through an iterative design process that's focused on how to run and create a business, how to develop a business to attract clients, and then how to create the foundation for the business. And so with the people who work with you, they oftentimes, by the end of your program, they're coming to a company like ours, or even at the start of the program like yours. They mentally are prepared to do the work necessary in order to be appealing to an outside investor. It's one thing as a founder, to just build your widget, whatever that widget is. But it's another thing as a founder to be able to sell the company to investors that build that widget and really share that dream. And so it's key. So anybody can do it. It doesn't mean everybody should do it.
Yeah, exactly. I'm happy you brought up what we do at M Accelerator. And for example, we work a lot with internationals, right?
Mm-hmm.
And I know, but it's worth to ask also to let our audience and community know about it. How can an international company be eligible to work with you through the regulation process?
Yeah, I think that for most international companies, if they've already have a balance sheet and they're really looking like the Australian company to be domestic and sell product into the United States, and they're looking to create that footprint, creating a wholly owned subsidiary is within their purview. They can actually get a Delaware or Wyoming corporation and begin the infrastructure of being a corporation here in the United States to then have access to raising capital domestically.
Yeah, and would you? I mean, of course, you will help, right? Because as far as I know, companies I'm working with, I mean, they're not really familiar with the U.S. registration.
Yeah, I mean, if someone comes and says, "Look, we're looking to bring our widget into the U.S. and we want to kind of help the economy and we want to do things that are going to bring more value to what we have," absolutely, we'll more than gladly help them get whatever development they need to figure out where to put them, so that it just makes sense for their business.
And I don't have many questions left. I mean, but another one is I'm always amazed by the amount of. I think recently I was reading an article. It's been called the dry powder, but I'm always amazed by the amount of financial resources. I mean, how with Regulation D? I mean, how much money are we tapping into?
So let's talk about the term dry powder, right? Because we're talking about Reg D, but we have to explain what dry powder means. You have companies like Apple who were almost sitting on $1 trillion in cash coming into this recent pandemic, and there are other companies, Amazon as well, who were flush with cash coming into this particular space. Well, that also goes for many of the major investment institutions, the private equity institutions who succeeded over the last 10 years through, just the success of the stock market. And along the way, they were just putting money on the side. There's trillions and trillions of dollars sitting on the sidelines. And just in the Reg D space alone, I think it was last year, over $1.8 trillion plus was put into private placement investment. And it's kind of become the next wave, per se, that because IPOs were getting a little bit more suspect in whether or not they're going to go out or whether it's time to promote them, many private companies have turned to the Reg D as a substitution to do an IPO. And the whole focus is to just get capital in the business and improve and make the business as best as you can before you go that route. And so there's more and more money on track to be invested in this space. And compared to a decade ago, that's almost a tripling of the amount of investment in the Reg D space. So now the beauty of this, though, and just to be clear, this whole thing that allows for the Reg D format as well as the Reg 8 format and CF was all created because of the Jobs Act. And the Jobs Act in 2012, in a similar situation, saw that small businesses were struggling and tried to figure out a way for private equity to go into them. So now that we're in a space where small businesses more than ever are struggling, this Jobs Act is really designed to help them find the capital they need to grow and expand and to get where they need. So it's a very exciting time, and founders really should lean on this.
Yeah, sounds great, and we're also excited to be, providing this service and talking about it. Yeah, it's so is there anything that you would like to say that I didn't ask you?
Yeah, I mean, I think that the question is, do we provide the services for free? We're a consulting business, and so we don't provide the services for free, nor do we work for equity in people's companies, nor do we work on founders' fees. And part of that is always because we're not a broker-dealer. We're consulting people along the way to fill out the right forms, set up how they survey the market. And so we can't legitimately sell or market or push people's stock out. The goal is really to create the infrastructure that allows that private company to do it themselves and gives them all the keys to success to bring in those private investors and share with our experiences along the way to make it better for them. So we don't, everything we do is flat fee. We don't get success fees. We don't get percentages of, and we don't angle for equity in founders companies because it's already bad enough they're selling parts of the equity. We just provide a really straightforward service for businesses. So working with us is pretty simple, and there's no real big hidden agenda. Working with us, we're trying to either bring you into or help you be involved in just part of an ecosystem. Like with people, we send to you, Alessandro, and an accelerator for consulting to make their businesses better locally. You understand the market here, or people who are just trying to make sure that they have, local fractional CFOs and local fractional COOs to really make them have a true business. Everyone is so used to being solopreneurs that they forget that if you're trying to expand and grow, you have to start thinking and treating a business bigger than really what it is at the beginning stages. I mean, you have to spend a lot of money, but you have to really start putting those processes in place so that as you grow and as investors are looking towards you, you've already thought of those things and you really focus on implementing all
that. Sounds great. Sounds great. And, so if anyone watching this live or watching the recording on our social media would like to know more about Regulation D, specifically 506C, or in other words, fundraising with accredited investors, and of course, knowing more about Drakoln Capital Partners, please check out our website. In the description of this video, I will make sure to put the link to a page on our website that describes some of the fundamental aspects of this, the regulation, this financial tool, essentially. So, Noble,
thanks, Alessandro.
And I would like to thank you. Thank you always. It's always a pleasure
The same.
to exchange, to meet you, actually, virtually, right? This time.
Right. So, yeah, take care of the family.
Oh, please, go ahead.
No, just say take care of the family. You guys be safe during this crazy time. And I'll be talking to you soon.
Sounds great. Sounds great. Before closing our live stream, just want to mention a quick announcement for next week. I'll be interviewing Scott Hindle, that you definitely know, Noble. It's our lead coach at them Accelerator, and we'll be discussing about online and virtual programs and why most of these programs usually don't work. So thanks again, Noble, and see you soon.
See you soon.
Bye, everyone.